You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest advice show. Today we have Ivan Barratt, real estate investor with a significant portfolio on Midwest. Please help me to welcome our guest today. How are you, Ivan?
Hi, Adam. It's good to be here. How are you?
Thanks so much for being with us today. And I would like to start on your beginning on multifamily. How was the beginning for you to say I wanna do an actual jump to the commercial real estate?
Oh, well, gosh, I am pretty lucky. My dad is an attorney and owned a lot of rental properties on the side. And so early on, I got the bug for real estate and always have wanted to own a lot of it. Early in my career, I got some great experience from mentors in the marketplace and made a very easy decision to focus on large apartment communities. Basically, I happen to think that they are the best return on investment of any real estate asset class versus the risk you're taking. And so from a risk adjusted return standpoint, or what is a great investment in real estate, I think nothing beats multifamily from the returns you can get perspective, but also how much risk you can reduce in multifamily versus some of the other real estate.
So your focus is more on multifamily space on the Midwest. You mentioned it's Ohio and Indiana. So can you tell me what was the upside for you to choose, especially on this market, especially was that there's an actual direction to invest more on the South, especially on Texas and Florida. So what was the upside for you to stay on your markets?
Well, here in the Midwest, I can find value. So versus some other markets that have become very, I would say, overheated, the Midwest, it doesn't boom, maybe like a Phoenix or some parts of Florida, but it doesn't bust either. It's more steady, consistent growth over time. For example, Indianapolis, my home market, average rent growth for 40 years has been about 3%. And I happen to think we can do better than average by buying value add properties where we can get the appreciation forced through reducing costs, right? And increasing rents. And so Midwest, you've got some big macroeconomic factors and in trends that are helping the Midwest. You've got several markets that have for a long time have been looked at as sort of a rust belt or decaying market. Well, you look closer, there's job growth, there's schools, there's good infrastructure. And so some of these markets like in Indianapolis, Columbus, Ohio, Kansas City, like we talked about before the show started, Des Moines, Iowa, are growing at a steady clip, even a little bit faster post-COVID as people have more choices on where to live. And so I can get assets at a better cap rate where I still know I can add value and exceed returns to my investors versus some of the more hotter popular markets where, listen, any market, it's hard to find a great opportunity, right? There's lots of assets to buy, but very few good opportunities. Here in the Midwest, it's a little bit maybe easier to find the really great opportunities.
I think one of the things that's happening right now is, as you mentioned, the market fundamentals, and with a lot of net immigration to the South, I see a lot of potential also in the Midwest. One of them is the compressed cap rate is better on the Midwest, better than the South states. But right now, how you see the impact of the compressed cap rate on both type B and type C products?
Well, I wouldn't know about type C right now, except from what a little bit of what I see. We are typically buying newer institutional quality assets that still have a value add component. I guess one way I could answer that, Adam, is the the pricing we were seeing on C and B property got so close to a similar cap rate that I could pay for an A property that it made more sense to buy something newer for just a little bit more money, where I still know I can add a return, but where I'm taking far less risk in having to, say, turn over a whole community of residents, fixing functionally obsolescent or deferred maintenance, those sorts of things. So as I saw a lot of players enter that C and B market, I found more alpha by being able to start the fund and target much larger institutional quality assets. Need a lot more equity for those deals, but there's a lot fewer competitors from time to time as well.
So you're more doing like an actual transition to the A products.
We've been buying what I would call A and A minus assets now for a few years. Typically, we're not buying anything anymore older than 2000. In fact, most of my vintage targets I'm looking for now are anywhere from 2010 to 2020.
It's more because of the inventory on the Midwest, because of the actual expenses on the maintenance, or just as you mentioned, there's no much spread between the B and A.
It's a combination of both those. It's a great question. You know, our job is to find returns, to find value, and take as little risk as possible. And so every year, it really comes down to finding that opportunity or that gap in the market where you can get the most amount of return or highest level of confidence in your returns, right? Nothing's guaranteed, but you want to have a high degree of confidence that you can hit your target. Again, while taking little risk. So in a vacuum, or in a nutshell, if I've got two assets and if everything goes according to plan, you know, I'll make, say, a 20% IRR on a 5-year hold. One of them is built in 1980 and one of them is built in 2000. And that's the only variable that I'm going to buy the newer asset than buying the older one. And like you said, like you alluded to, you know, the spread or the price between those two assets is fairly compressed.
We talked about one of the things about the upside of the Midwest. Can you tell me more about the challenges on the Midwest and how you see that there's an actual risk mitigation to this market, especially because more your experience on your market, as you mentioned, you've been 20 years on the market, so you know where is the actual gap on the market.
Well, this is agnostic to markets, but the best way I can answer your question is that the risk is really in the execution on any deal as an investor or a limited partner or a sponsor. In my case, the real risk comes down to being able to execute your business plan, to be able to manage that asset effectively. And that's why at BAM, I started a property management company first before I started syndicating deals. So that I could minimize that sort of risk. In any market, you know, you have to be disciplined about what you buy. Disciplined acquisition criteria is the most important thing. And I think right now you're going to start seeing some assets where people shouldn't have paid what they paid for them. Some skinny deals are gonna come back to the market. And I think you're going to see some investor equity dry up. You're going to see other investors making more returns now than they have in the past because of the opportunities that'll be created because of the volatility in the market.
Yeah, on the last 2-3 years, I think that is what you're mentioning as overpricing all of the properties, having a lot of new syndicators on the market was not a healthy environment. And as you mentioned, all of this is going to happen. What's going to happen is potentially all of this deal is going to potentially come to the market, especially because of the new interest rate, which is the impact of the recession. Back to this point, how you see the
well, you won't see them. Many of these things you won't see hit the market, Adam. you'll see lenders going directly to their good owner operators that know how to turn around a problem. And those folks will be taking over those assets on behalf of the lender, which won't likely lose money because leverage is down. Unfortunately, it'll be the LPs and the sponsors that were maybe too impatient or didn't have enough discipline to pass on skinny assets.
I think you're mentioning to the bridge loans when the actual the position is going to go back to the lender himself, whatever it's a private equity or private lender bridge loan, correct?
Correct in the most part. I mean, there's some specificity in there or some nuance because you've got bridge lenders that are good lenders, right? That are good partners. And you've got on the other side of the spectrum, you've got loan to own bridge lenders who are hoping sponsor fails. And when markets turn, it starts becoming pretty obvious who those loan to own lenders might be.
This is one of the things that's what everyone is waiting for, I think, on the recession turnover. But how you see the impact right now, because we opened the subject of recession and the impact of recession on the multifamily space, especially that we see so far that all of the market fundamentals is still strong of most of the markets. But the problem is, as you mentioned, is how this deal has been structured based on lower interest rate. So right now, how you see the impact far from this, for how you see the impact of the recession on the flow of deals?
I'm seeing more deal flow than I have since 2020. So right now it smells a little bit like the beginning of COVID when I was able to transact some of the best deals of my career because a lot of people paused and thought that a big crash was coming. I'm not saying a big real estate crash is coming, but it is creating some opportunities on the buy side of the market. Nothing like 2008, but I am seeing more reasonable pricing, more opportunities, and fewer bidders for those opportunities. Because right now, so for example, we're looking at an asset that's, call it 65 million. To purchase that asset, and our leverage on that deal is going to end up being maybe 60%. So that's a pretty big equity check that I've got to raise in order to close on that deal. And how I can do that is finding assets where I know I can reduce costs, but also grow rents significantly in order to still drive home those returns with more equity and less leverage. So there's always these different variables moving in the marketplace, right? And it's my job as the, I'll use a sports analogy here, the quarterback. I've got to play the game that I'm being given versus trying to force too much of a playbook. Every year, every quarter, I've got to throw out the playbook and go, okay, what is the market doing right now? Where are we at in the cycle, and what are the opportunities? Because there's opportunities in every part of the cycle if I am disciplined enough to figure that out and stick to that plan. The one thing I can't change, Adam, is what I pay for a property. So I better be darn sure that I'm getting it for a price where I've got a high degree of confidence in hitting my returns. Otherwise, my number one asset, my track record, suffers, and my ability to raise capital in the future suffers.
I think you open a really good subject here, which is basically the impact of recession on having an actual preferred returns on your deals. How you see this on your deals? Are you still working on the same strategy with the same returns, or you think right now we're on the actual cycle where the sellers have to lower their expectation on the price wise?
We still target similar returns that we've always targeted. We are seeing more sellers recognizing that the price they thought that their property was worth 4 or 6 months ago is not a price they can get in today's market. I would say we've gone back from insanity, which would be, sub 3 cap rates
Hmm.
in certain areas, back up to a normal cap rate. It still really comes down to what can me and my team do to the property to drive returns. So
Yeah.
preferred returns haven't changed because the types of assets we're buying haven't changed. Cash flows in the beginning certainly are going to be less than they might have been in the past.
Hmm.
So it's even more paramount to find deals where we're highly confident in the ability to increase that valuation, which, every dollar I save, if it's a low cap rate environment, is a much higher multiple on sale. So it's just there's some balance to it, and different investors have different appetites for different types of investment.
So what is the current cap rate you're working on right now in the Midwest, especially based on Indiana, especially
Well,
on
Adam, one of my mentors, it's like one of my mentors told me a long time ago, and I'm happy to share with you this little secret I learned a long time ago.
Yeah.
I don't care what the cap rate is. Now, there's some caveats to that. I care less about what the cap rate is, right? I care more about what I can do with that asset after I close on it and bring in my management team and new capital. I care what the cap rate is in the second year, the third year after I start executing my business plan.
Yeah.
And I care more about having a high degree of confidence that I can return 2 to 2.5x to my investors on a 3 to 5 year window.
I think this is a really high returns right now, especially on the market right now. Is multi equity multiplier to 2.5 is really competitive on the market. And as you mentioned,
Yeah, but just to answer that, a little bit further, I bought an asset recently that the seller thought he was selling to me at a 3 cap. Okay. I actually bought it at 4.5 because of what I know I can run it for. And I was able to go in immediately and reduce a lot of expenses that didn't need to be there. And then further, I knew by buying that I could raise rents immediately on lease turnover, not everyone at once, but as leases turned over, I knew I could raise rents at least $100 a door just by bringing the leases up to market, not even making any physical improvements. That was a great deal for us.
So as you mentioned, your focus always on adding value, even in the market of Class A, which is bring you to the point of how you can increase the net operation income. And one of the things you said is to bring the even without adding any value to the market value of the leases. One of the things you mentioned that you're working right now on the fund, I think your current structure is more like a fund or more like a syndication.
We're on our third fund. This one, let's see, fund one was about 50 million. Fund two is about 75 million. And our third fund can go up to 125.
So what was the upside for you, and what was the actual progression make you to start on structured funds on your multifamily deals?
Why did I go from a syndication single asset raise to a fundraise?
Yeah. Especially as this is a pros and cons for your investor, especially when they are dealing with syndication or fund. But what I see is basically that I think you find that it's more flexible and beneficial for your business model to go with a fund, correct?
Yeah. So first and foremost, going from a syndication, a single asset syndication to multiple asset syndication, which is all a fund really is.
Yeah.
That was one of the hardest things I've ever done because I literally had to speak to every single investor and walk them through the advantages to me as a sponsor, which are several, but also the advantages to the limited partner as well. Some of mine are pretty easy. I get a longer runway of raising capital. I've got a bigger pile of ammunition when a big institutional deal comes along. So when we have to raise 20, 30, 40 million in 60 days, I've already been raising for a while by the time that deal comes along. So it allows me to just always be raising capital. So it's much more efficient for the team. And then for the investor, instead of putting their 50,000 or their 5 million or $10 million into one project, they're spreading it out across a portfolio of assets, which lowers their risk profile overall and gives them a higher probability of a higher return, because nobody knows out of 5 or 6 assets in a fund which one's going to be a home run or a triple or a single or a double. But what happens is they get exposure to all those assets. And so if one does okay, it doesn't really pull down the return too much. And if a couple do really well, it pulls up the overall return for everyone. So there's a lot of advantages to it. If you're a syndicator and you're listening to this, I would say the easiest way to really get into the fund game is to first have a good track record in the single asset space. But raising funds eventually makes the whole machine just hum a little bit better, if that makes sense.
Let me tell you, you mentioned something about raising capital, and I want to focus on that. How was your actual progression on dealing with investors and family offices and private equity firms? What was your approach when you're raising capital, especially when you're dealing with $125 million funds? Is going to be easier to deal with family offices with back checks than dealing with 150,000 check with qualified or qualified investors. What was the actual plan for you when you started to raise capital for a bigger fund than your initial funds?
I think I know what you're asking. So I don't work with private equity companies. I built my own private equity platform.
Okay.
We raise all our capital, a little over 300 million now, all from individual high net worth investors.
Oh.
And that's everyone from somebody who's just maybe net worth a little over $1 million, and they're putting in $50,000, to some of our larger family office type individuals or families that have hundreds of millions of dollars in net worth and are allocating a percentage of that to my team, and everything in between.
I think so. Dealing with family office is different than dealing with investor. Of course, it's more the structure itself of submitting or presenting the deal or the fund is different, but it's easier than dealing with private equity fund. As you mentioned, you already have your private equity fund. I want to ask more about a fun question here, or a fun question about how you describe your superpower.
My superpower?
Yes.
Oh man. Great question, Adam. I don't my superpower these days is the team that I've been able to build over the years. They deserve so much credit for what we've been able to execute now. I think I'm pretty good at creating vision, pretty good at telling a story and getting confidence from my investors. I've raised a lot of equity myself, one meeting at a time. And luckily I've been able to find great people to surround myself with that are much smarter than I am in many areas of many required areas to be successful in running an enterprise.
I have a question always I like to ask my guests is about the mentorship. What was the really lesson you learned from your mentors? It's really help you to scale a lot or scale your business faster than expected.
Yeah, we could spend a 3-hour podcast on that. We could talk forever about that. I would say that in the short amount of time we have left, my greatest one of my greatest pieces of advice would be to not only seek out mentors, but if you would like rocket fuel in growing your own business, you need 2 things. You need to be in peer groups of other like-minded individuals. Some of my best peer groups were through EO, Entrepreneurship Organization, because you're in a peer group with other entrepreneurs in vastly different businesses, not just real estate. and being around other entrepreneurs, doing things in different industries, and learning how they're doing what they're doing has been greatly applicable to my own business and added a lot of value. And then marrying that with coaching in any area of my life where I'm trying to improve, whether it's my marriage or being a better father, or my fitness, especially running my business and running a team. I've got a coach in that area that I'm talking with on a regular cadence, or working out with if it comes to training. That's helping to keep me accountable and bringing a lot of experience and wisdom to the table. And so if, I get that question a lot, what would I do differently if I could go back in time? And the one answer that I usually is first place for me would be to have coaching and peer groups as part of my formula early. I figured that out in my early 30s. But if I could go back and tell my 21-year-old self that, that's what I would do.
Thanks so much for your being with us today. And the final question will be how the people can follow your success.
Sorry, how
the people can follow your success.
Oh, I'm easy to find. Let's see, my name is right down there at the bottom, Ivan Barratt. If you Google that or Google BAM Capital or Multi-Family Syndication, I usually come up pretty close to the top, but we're on all the things.
Thanks so much for being with us today, and we're really happy to bring you again to talk more about your success on multifamily space. Thanks a lot.
You bet, Adam. Thanks for having me.